Morning, market chameleons, and my soon-to-appear favorite chameleon, Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
Great. Unfortunately, everyone should know Jake is not going to be able to do his show today. He's come down. He's quite sick. He was emailing me over the weekend, so we'll reschedule for next Monday. We'll have first call with Jake next Monday. Before we get started, why don't we do this disclaimer? What do you think?
Yep. Good morning, everyone. And keep in mind, before we get started, that Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
So what are you thinking about doing this morning, buddy?
I think what we'll do is we'll continue on the Q&A, because we did have, I think some very good questions last week. And if you guys have any questions, you could put them in the chat. We'll read them to me, or you can also, Will's going to provide a link. You could use that link to come on the show, raise your hand. We'll turn you on. You don't have to turn on your video, but we'll turn on the audio. This way we could hear the questions. The audience could hear the questions. We could also, have questions around your question, just to make sure that we understand the question correctly. But that's always, I think, actually makes it better, more clear. Sometimes you type in the question and we're making assumptions what you're asking, because you have, you're asking a question in one sentence. So while we're waiting for some of the questions to queue up, I'll just start looking at what's going on in the pre-market report. I have some other questions that always come through, either through email, through chat, other conversations with customers. I jot them down, so I'll cover some of those until we get some questions coming in. How's that sound?
Sounds good, buddy.
All right, so this is the pre-market report right now. These are stocks trading in pre-market. We got the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm coming down here just to look at how many made our percentage gainers list, and I see 118 stocks today on our percentage gainers list, 33 on the percentage decliners list. So from that perspective, looks like a more bullish bias at the open. I'm going to take a look at the higher market cap stocks, see if there's a similar situation here. So I'm using this market cap filter, stocks 20 billion market cap or higher. We got 30 that made our percentage gainers list, 6 on a percentage decliners list. So from that perspective, still looks like a more bullish bias at the open, like 5-1. The only one really standing out at me right now is the Square, Jack Dorsey's company, and I think that they're down, but they're purchasing another company, I think Afterpay, for all stock. So that's just coming down a little bit on that news, but that's a merger that, it seems to me that there's going to be a lot of innovation coming down the road as far as payment processing goes. So you're seeing, especially, you got blockchain technologies developing around that. You have new companies developing around that. So we're going to see I think a lot of growth there, right? Digital payments, digital finance. So it'll be interesting just to read more about what he says in there. But I think that's the news today, that they're buying Afterpay for like $29 billion worth of stock. If you don't have any questions yet, Will, I'll just kind of start on some of the questions that were remaining from last week, kind of hanging out.
Yeah, no questions have popped up yet. I have put the link to the Zoom in the YouTube chat, so anyone who's new can come over anyone can come over, click, and ask their questions live. I do see we have a new chameleon. Welcome, Rand the Man. He's a new chameleon. Actually, another new chameleon showed up, MF Casado. So those questions asked live, I think, are super helpful. So the link is in the chat for anyone who wants to come over to Zoom and just raise your hand.
Yeah. All right. So while we're waiting on that, I'm just going to go, I just picked like a random stock, 3M here. So I'm on a 3M. I'm going to come down here to the options chain real quick. Show one thing that's kind of new we added, and then I'm just looking at my list of questions, and I think I'll talk about maybe like a conversion reversal or risk reversal. So let's come down here on the options chain. I'm on 3M. Let me just come down to August 20th expiration. So one of the things that we did add, this was, requested by multiple customers. So when you pull up on the options chain, you could click on any of these bids and offers, the calls or the puts, and create a strategy and a payout diagram. So for example, here, if I click on the 200 call, right, there's a bid, $1.92, an offer 203. I click on that 203, it kind of brings up a ticket here, populates, buying August 20th expiration 200 call for $2.03. Okay. And you could change these, to a sell, change the expirations, exit, but by clicking on it, it kind of auto populates it. So if I hit this load strategy, it gives me a payout diagram based on, buying it at 203. But you can see here that there's a bid of $1.92, ask 203, midpoint 198. So that would, depending where you purchase that call, the payout diagram will change, right? So if you purchase the call for 203 and the stock drops or doesn't go up in this situation, then you're risking $2.03 and your break even. It has to cover that, go above the strike and cover the cost of that option. So we had that fixed. People requested, like, well, let me change the price, and take a look at it. So here you could now change the price. Let's say you want to go down to $1.98, redraw the diagram. So this will assume, okay, if you bought $1.98, your max loss then is $1.98. Your break even is a little bit better now, because now instead of covering the cost of a 203 option, you only have to cover the $1.98. And where this might come in helpful also is if you're doing a strategy multi-leg and you kind of want to see, okay, well, these markets might be a little bit wide. If I buy this call, then I'll sell this call to 7.5, right? And I run the payout diagram, and according to this is my payout diagram at expiration. So you could see here that this is assuming I pay 288, right? So that's my payout diagram. But maybe what if I tried to do it at the midpoint, 273 or 275? So you could start kind of just moving those down. What if I did 5 cents better here, sold, 5 cents better there, loaded that strategy, and then you get a different payout diagram. So this just lets you kind of change the numbers around, to redraw that payout diagram. Maybe, you just want to do it at the midpoint or a little better. So that's kind of the idea there. You could change those prices to rerun the payout diagram. Okay, if there are no questions here, I'm going to kind of move on.
Yep, you can move on.
So we talked about yesterday, I'm sorry, last week, not yesterday, last week. Yesterday we were closed. We're looking at an options chain, and we said, okay, if we're looking at this options chain and, let's say this one call looked like it was bid up. So we're like, well, what would we do against it? So if we sold this call, then I'm sorry, it went the other way around. It looked like we went out further in time and we said, well, this particular call looked cheap. So if we bought this call that was trading relatively cheap, looked like there was a big seller there. One thing what we might want to do against it is look to put on a time spread and sell a call that's near term, right? So I think that's what I did, said, well, this call looked like people were buying, so it looked like a good time spread. Basically selling the nearer term, buying the longer term. This way, we drew a diagram. If the call in the near term expired worthless, then we'd have the call in the longer term remaining. And then a question popped up, well, why not just sell a put in the same expiration? So you're buying one here and then just selling the put in the same expiration. And the reason there is first of all, it's a different risk reward. And now, it's a different payout diagram, different risks involved with that. And essentially what this is doing a risk reversal, right? You're buying a call, upside call, selling a downside put. And a few things I wanted to talk about the risks of this is that, because I do get questions like, well, what is a call spread? What is a put spread? What is a risk reversal? Now, these are questions you could Google and find out yourself. You could go to the Options Industry Council. I think you could even speak to somebody there, but it's a free resource paid by the industry. They have videos on there. You could Google it. We have other videos. So something like, what is a call spread? What is a put spread? This is something you could do yourself. You don't need to really ask. It's not based on somebody's experience. It's just out there, that knowledge. But there are other questions that I think are more interesting. It's like, well, what happens? What are my risks? What should I be looking out for when I do it? So I think those are more interesting questions. And that's what some of the things that I wrote down I'm going to talk about. So maybe let's start with a simple one, before we get into the risk reversal or the conversion reversal. But for example, when you do a vertical spread, right? Like you sell 190 put, buy the 185 put. So the question is, okay, I did this spread, right? I see my payout diagram. And in this case, the best case scenario is if the stock stays above 190, right? Both these puts expire worthless and I get to keep this credit of $1.10. So that's all good. Well, that's in the best case scenario. I have to do nothing. But what happens if the stock goes down, right? So there are two situations here that could potentially happen. Now, if the stock crashes, let's say really low, right? Way below, like let's say, to 170, 160, 150. Well, both of these puts at expirations will be in the money. The 190 put will be deep in the money. The 185 put will be deep in the money if the stock's, let's say, 160. So what happens is you automatically get a sign on your short put, but you automatically exercise your long put. So basically what happens is in effect, you buy the stock at 190 and then you sell it at 185. So there's a $5 loss there. You did receive $1.10 credit, so you're losing the difference, right? You sold it for $1.10, you're buying it back for $5. You lost $3.90. So in that case, you did nothing. It was just either you made or lost. Now, what happens if the stock is in between, right? At expiration, like 187. So it's in between your strikes. Well, there you might have to take some kind of action, because what will happen is it's below your short strike of 190, but it didn't go below your 185 strike, which means your 185 strike expires worthless, but you're going to get a sign on the 190. If you get a sign on the 190, at expiration, right, your option goes away, it gets converted to stock, and on Monday now you're long stock. That's what's going to happen, right? So all of a sudden you come in on Monday, and instead of an option position, you just have a stock position. You're long 100 shares. So when you see that, that's your risk, right? When it's in between, and you don't want to be long stock on Monday, that wasn't your intent. You just wanted to do the spread, and at expiration, you're done. You're moving on to something else. You have to close out of it, right? So there are two ways you could close out of the option. or at the, if you think that you're going to get assigned and it's closing at 187, you have to sell the stock, either short it to offset it, right? Or you buy back the option because you're going to get assigned and you're coming in with the position. And that position is like now long stock, you've lost your protective put. So you got to be careful of that. I think that happened to somebody on the Robinhood. Right? Well, you heard about that. There's a young kid. Maybe it wasn't clear to him. I don't know if the broker explained it. I'm not sure, but you do these vertical spreads. You just got to make sure at expiration, depending where that stock lands, you might be coming in with a position on Monday if you don't close out those legs. Make sense?
Yeah, that was a terrible situation. I think that was actually a misunderstanding. He was actually flat, but the way it read was wrong. So it was.
Okay. Maybe
yeah.
I missed this. Maybe he was flat. Maybe something on a statement. Then he didn't.
But he couldn't. It's all online, so he couldn't get in touch with any. It was very hard to reach customer service at Robinhood. I don't know if it's still that way, but he thought. They were asking for, a number with lots of zeros behind it.
Yeah, he thought he lost. He incurred a big loss, which he didn't. But I think it was like in a form of a haircut, right?
Correct.
Something like that. So that question kind of like comes up, and those are things you have to be careful with, and you should call your broker, because they should be able, to describe to you exactly, that risk, and what you can do, and the whole process of exercising in assignments.
Hey, D, we do have someone who's brave enough to raise their hand, which is always
Okay.
nice on the Zoom. So they came over.
Okay.
They raised their hand. It's Randy. So I'm about to allow him to talk. Is that all right?
Yeah.
All right, Randy, you're coming on live. Here we go.
Hey, you're still on mute.
Oh, sorry. Actually, that's Matt. I think it was Randy who wanted to.
Okay. Do we have two people?
Yes, it was Randy.
Okay. All right. Hey, Randy.
Hey, Randy, you there?
Hey, good morning. Can you guys hear me?
Hey,
Yeah,
good morning.
How are
you?
We got you coming in loud and clear. Thanks for joining, Randy.
Okay, sweet. Yeah, absolutely. So anyways, this was in reference to one of the vertical spread discussion that Dimitri was putting out earlier today. So I played around with the website a bit, but I can't seem to find where to compare the implied and historical volatility. If you just could go over that, that'd be great.
Okay, so you're talking about just implied historical volatility in general, or you're talking about in terms of when you're doing vertical spreads?
In terms of when you're doing vertical spreads, sorry.
Okay, so when we talked about, and I mentioned this a little bit last week, when you're doing a vertical spread, you're buying and selling an option, right? A vertical spread in the same expiration. And whenever you're selling an option, you're selling Vega. When you're buying an option, you're buying Vega. And in terms of a spread, you could be, now there's an assumption, and I think this is a problem. There's an assumption that if I'm selling a spread and receiving a credit like this, right? So I'm receiving a credit, right? There's an assumption that I'm always getting short Vega, right? And that I want to sell high implied volatility. This is the assumption. And that's not necessarily true. So what happens is wherever the stock lands, if it gets closer to your long strike, because that's your position, you're going to get long Vega. If it's shorter to your short strike, you're going to be short Vega. And that could change at any time, right? Doesn't matter what your initial position is. Your position could go from short Vega to long Vega. So you could end up actually being long Vega, and you're not actually playing an implied volatility. This is maybe more of a skew, but not an implied volatility. So let me show you something here. I'm short Vega, 6.1, right? And that's because the stock price, 197.94, is closer right now to my short strike and further away from my long strike. If the stock moves, that's going to change. Let me show you how that works. I'm going to do you a different call, put spread. Let's say I'm short the, sorry, I am long the 200 put, and I'm short the 220 put. So you can see here, I still have a net credit, 1365. I'm collecting, right? So I'm collecting bit of credit, but look at my Vega position, long 28. You see, so when you're doing a vertical spread, it's not implied volatility, right? Because the implied volatility will not help you. Maybe skew, but not the implied volatility, because it just depends where the stock is going to land. And if it goes to your longer strike, you're going to be long Vega. And if your intent was to be short implied volatility, then you kind of did the opposite. Does that make sense so far before I move on?
Interesting. Yeah. I'm there's a lot. I come from more of an investing background, and options is a completely different beast. So it's definitely interesting to hear about this, because I've always came from the context of credit spreads or something big with implied and historical volatility, but never really considered Vega being a big role into that.
Yeah, and it's a big problem, because let me show you, if implied volatility in this situation comes in, you're going to actually lose money. So you're what's happening is it's the reverse of what your intent was, right? Like in this situation, implied vol comes in, and this is saying that your losses will go up, right? So obviously this is at expiration. It won't, at expiration there's no more Vega, but if you do it, pre-expiration, your losses will go up if I start moving these implied vols in. So, keep in mind you're doing two things, right? You're not doing one thing, you're doing two things. You're buying something and you're selling something. And one of them is going to give you a long Vega, one is going to give you a short Vega. And the Vega will be the highest in the at the money option, right? So the at the money option will be the highest. So whenever the stock moves closer to your strike, at the money, that's where your Vega is going to be the highest. So that's why when you're screening for credit, spreads, credit put spreads, credit call spreads, doing it by where the implied volatility is does not make too much sense. Now, we do have theoretical values that look at the stock behavior during high implied volatilities and low implied volatilities and look at the distribution of returns. So it's kind of embedded in there when you're doing the screen. So it's looking at, well, what did this stock tend to do when there's high implied volatility? Where did it end up, in 5 days, 10 days, whatever the distribution is. But screening by implied volatilities for vertical spread does not make too much sense, not to me. Now, one thing you are doing, though, is doing a skew. So you see here on the 190 strike, you see that the implied volatility is on the bid is 19.4. The implied volatility in the offer is 20. But if I go to a lower strike, the implied volatility is there 25, 25.9. So you are buying or selling skew, right? So here I'm selling 25 vol. Here I'm buying 20 vol. And now one way that it's potential that you can profit is if the skew comes in, right? So if this remains 20 vol and the one I sold goes from 25 down to 20 vol, right? Then my short side will start converging and I may potentially profit from that. Okay. But skew and just general implied volatility is different. Skew is the difference. It's the difference in the relative implied volatility of one strike versus another.
Right. Okay. Yeah. Thank you for that.
Sure. And I do, and that's a good question actually for the reason that it comes up a lot. Put in the, IV30, and that comes up a lot. And I try to say, well, if we did that, I don't know what use, it wouldn't make that much sense to
Right.
screen by like that.
Okay. Yeah. Definitely appreciate that, guys. Thank you.
Yep. Yeah, definitely.
Hey, Randy, thanks for stepping up and coming on live. Super helpful. Come back anytime. We appreciate it.
Absolutely. Will do. All right. Happy trading.
Awesome.
Good luck, guys.
Bye.
Thanks, Randy. Bye. Was there another one? Well, somebody else.
Well, we've
raised
got
their
other questions. None have popped up live. And
Okay.
Randy, again, that's really appreciated. Brad Moore, coming off that question, is asking, so what's the best way to look for an edge on a credit put spread, was his question.
Right. So when we look at it now, quick way, we do have a summary here of trade ideas. And, these are, because I think somebody asked about like the top ones less. And I said the top, you have to look at, well, top by what? You have to kind of define it either by edge, like a stop. If you say, give me the top stops, well, what is, does that mean by market cap, by revenue growth, by earnings growth, by, you have to kind of define it. But here we do kind of start by edge. And if you look for it in here, we have some presets. So you could kind of have a starting point, so this one kind of filtered out a bull put spread based on theoretical edge. Or you could go to the screener here, bull put spreads, and you could start using these filters. Now we have videos on how to do this. I only have a couple minutes, but if you go here to the videos, and anybody could go to these, I'm sorry, not these videos, under help, video guide, go to options trading, strategy screeners, go to credit put spreads, and this will give you different videos, how to use the screener. Okay, you can watch them, and it gives you different ways looking for different stuff. I won't be able to do that all in 4 minutes, but it's there. Anybody could go in there and take a look at them. So I think, if we have like a quick question, Will.
Yeah, we had a quick question. I think it was from Rob, and it was around, Rob was asking, can the after hours trading change the exercise price if the stock closed out of the money and then rose? I'm assuming what he's asking is, say it's expiration, right? And right after hours news comes out and the stock was initially out of the money, but then, the stock price has made it in the money. Those still can possibly get exercised, right?
Yeah. So that's actually a very good question. So the question is the following. Let's say I'm going to try to pick something that these are Fridays after market, prices, right? So a stock, officially closes at 4 o'clock, right? And then there's like this official closing price, whatever it is, New York Stock Exchange or NASDAQ, wherever it's listed has an official closing price. And based on that closing price, the Options Clearing Corporation, determines which options become assigned and exercised, right? So the in the money options become they're automatically exercised. The ones that are out of the money, those go worthless, right? But what if there's trading after hours that pushes the stock through the strike? So like, for example, I'm just going to use this top one, HUT. After hours is up 37 cents, right? And so, which means that the official closing price was below $5, right? And if you had a short call, you think it expired worthless, right? Because the price was whatever it is, like 470 something, right? And you think, okay, I'm good. It expired worthless. I'm not getting assigned on this call. But after hours, it's trading above $5, 5.10. Well, somebody who's long that call could see that and say, well, I choose my right to exercise my 5 strike call. You still can do that. I think you have until what, 5 o'clock, Will, to exercise your call.
Yeah, I'm assuming it operates the same way. And we used to stay on the floor in the offices till 5, in case anything like this happened. And inevitably, it would at times on expirations.
Yeah,
and
so
you have a lot of
cross-
weeklies in your positions. That's every week.
Right, exactly. And it could cross the other way, and that person decides to exercise, and you might get assigned on it. So you may potentially come in with, if you're short, you may come in with a short, stock, because you got assigned, or you could exercise, right? If you're long it and you're like, oh, wait a minute, it crossed $5, there's news, whatever it is, you exercise it, you could buy it at $5. If it's trading after hours at 5:10 and you could buy it at $5, potentially sell it then after hours at 5:10, well, you made an extra 10 cents, right? Maybe your broker lets you trade after hours and you're like, well, I could exercise it and short the stock at 5:10 and I made a 10-cent profit. So yeah, after hours, there is a potential that even though you think the stock closed at one price, if it moves after hours, it crosses a certain strike, then and you could also choose not to exercise, right? Let's say somebody who's long a put at $5 and he sees the stock cross 5:10, I think you could choose not to exercise, correct, Will?
That is correct.
So like a do not exercise. You're like, well, I don't want it, right? I choose my right not to exercise. And that could also happen. So yeah, that's actually a very good question, something to be aware of.
Absolutely. Great job, team, as always. Thanks to Randy, a new chameleon who came on live today with a great question. Rob, Brad, thanks for the questions. Great job, Dima.
Yep. Thanks everyone for joining. Stay safe out there. Hope you guys have a great trading day and hope to see you guys tomorrow.
Yeah. And again, a reminder, no first call with Jake this week. We will have it next Monday.
Yeah.
Let's all send our positive thoughts to Jake that he feels better at the end of this week. And we'll see you Monday. D, I'll see you tomorrow morning. Thanks, my friend.
All right. Bye, everyone.
Trade in peace, community.